All right, hi everybody. This is Darren McHugh from DTC and Dental Technology Center, formerly known as. We thank you so much for coming to the webinar, part of our monthly webinar series. We have, again, recap why we do these webinars is we've been getting a lot of questions from our practices about all different sorts of industry topics, things related to everything else besides IT. And we just wanted to be able to provide a resource to our clients in the dental community with some answers to some of the questions that we keep getting. So today's webinar series, we're really fortunate to have Andrew Gerner from RK Tongue. He has graciously donated his time to us. I've known Andrew for years now, and he has certainly become a staple in the dental community with RK Tongue and the insurance services they offer, as well as the wealth management services. Just a little housekeeping items. So essentially everybody is on mute right now except for Andrew and myself. We will go ahead and be able to answer any questions that you may have. You simply type in a question into the little box there and hit submit or enter. We'll see that pop up on our screen. We'll do about 25 minutes of content from Andrew, and then the last 15 minutes or so will be a Q&A. Again, we know that everybody's donating or sort of working through their lunch right now, and we really appreciate it. So we'll make this hopefully of a great value for you. At the end, just again, we'll do the question and answer period. But before we turn things over to Andrew, to let you know that our next webinar series is on July 13th. It is starting Q3, and Q3 is going to focus on marketing. So, man, we get this question all the time, especially from new startups. How do we generate patients coming in, and how do we, enhance patient communication? So, we've got 3 fantastic webinars planned for July, August, and September, all focusing specifically on marketing and patient communication for the dental practices. So really excited to get that going next month. But again, very appreciative of Andrew donating his time. Andrew's going to take us through the financial planning side of your practice and just make sure you get some of those solid pieces of information to help you continue to plan for your personal or for your practice and your personal financial status. So with that, I'm going to turn it over to Andrew. Andrew, the floor is yours.
Thanks, Darren. Everybody hear me already, I assume? Of course, they're on mute, so you can't respond. But I'll assume everybody can hear me all right. I'm going to apologize in advance only because I don't think I've ever successfully limited myself to 25 minutes of speaking, and this is a fairly content-rich little presentation that I've put together. So I'm going to move fast. Darren, I'm assuming you have some way to take questions as we go so that we can field them at the end, because it can get a little bit dense, let's call it, with some of the mathematics that I'm going to throw around. So this is the slide that the attorneys wrote. I assume that you are able to read that in this brief time before I click past it. It basically says that I'm not a CPA, I'm not an attorney. You're supposed to get advice from those 2 types of professionals if you are going to make any decisions related to law or tax matters. It's also telling you about the usual securities industry stuff that every disclosure has ever said from my industry. Here's our contents and the things we're going to try and touch on today. The big 3 that I really want to focus on is, most of the audience, as I understand it, is either a relatively new practice owner or aspiring to be so in the near future. And one of the common threads that I encounter among those particular types of clients is a shock, usually sometime around the 2nd time that you have to file your taxes. In the first year, when you've got all of your startup costs, your build out, your equipment, all of your IT investments, etc., there's this wonderful section of the tax code called Section 179 that essentially allows you to depreciate all of your capital costs in that first year when you made the investment, subject to some caps. It effectively wipes out any taxable income for most practices that are startups and many practices that are acquisitions in need of some upgrades. But come year two, all of those nice accelerated depreciation allowances have been burned up, and the huge tax bill comes along. It's one of the most common threads that I see. And really, one of the things that I want to do is expose everybody that's listening to at least one or two strategies that might help mitigate that tax bill. Not eliminate it, because Uncle Sam always gets his piece, but at least we can try and shrink that piece legally and ethically. So we're going to think about how much should we be individually and personally saving for retirement, because that's foundational. You wouldn't even be working if it wasn't for the fact that one day you'd probably hope not to work anymore and do whatever it is that you would prefer to do as your hobby. And if your hobby is dentistry, then feel free to tune out now. Otherwise, we're going to try and figure out how to get you on the beach or fishing or playing golf or whatever the case might be. We're going to think about tax consequences, both present and future. We are going to figure out a little bit about the investment strategy component and the tax management strategy component of some of these benefit plans that you can put into place that might disproportionately benefit you as a practice owner because of the tax management capabilities and the savings and investment capabilities of those benefit plans. We'll think about investments themselves in terms of diversification and risk. All investments involve some degree of risk. I'm not going to go and read every slide to you, but what we're talking about here is public information specifically about 401k type plans and qualified plans in general. 401k plans would be the most common example. In Maryland, and I don't know if we have multiple states represented on this call, but in Maryland alone, dentists sponsored 864 plans, and the total assets was a big number. It's actually obscured from me because of the panel here. So yeah, it looks like almost $1 trillion of assets. I'm sorry, almost $1 billion of assets across Maryland dentist qualified plans as of the end of 2015. That's a lot of dollars, and there's a reason for that. There's a lot of retirement plan options, and this decision tree here, I've lopped off a portion of it because the left-hand panel would relate to nonprofits. I don't think we have any aspiring nonprofit operators on the call, but we probably do have a lot of S corporations and LLCs that are going to be taxed as S corporations or partnerships or sole proprietorships. So this decision tree I'm not going to go through. It just shows you exactly how complex it can be to select the type of retirement plan to implement in your dental practice. And as I said before, the reason we would do this is in large part for the financial benefit of a practice owner and to mitigate some of those big bills that we would expect to see in our second year and beyond as a practice owner. All of this sort of stuff that I'm going to go through initially is very foundational, just concepts associated with retirement planning or financial planning in general. So here I'm going to talk about the personal nature of these sorts of retirement plans, why we're doing it in the first place. And again, we're doing it for the same reason that we're starting or we're purchasing a dental practice in the first place, which is hopefully to enrich ourselves financially, to give ourselves freedom, and that's hopefully going to last well beyond the time that we do own a practice. So our experts, and that's a lot of people, all the way down to Mr. Schiller, are telling us that on average, and there's lots of opportunities to consider yourself not average, that's an individual conversation, but on average, we have to assume that an individual or a family is going to need 70 to 80% of their pre-retirement income while they're in retirement. Um, there was a time that once we were in retirement, we figured it was safe to withdraw 4% from our nest egg. Of course, that was a time when retirement age was 65 and most people were not on this planet anymore in their current form by the time they were in their early to mid 70s. That's not the case anymore. We're seeing folks well into their 80s and 90s. That means we're having retirements that last nearly as long as working years. A more contemporary assumption nowadays might be a 3% drawdown. And with some of these bits of knowledge that we have now and making some assumptions about other variables, we can now figure out exactly how much we should, in theory, be saving for retirement to achieve our goal of that 70 to 80% of our pre-retirement income while we're in retirement. Oops. So the first step is we have to figure out the lump sum we're going to need. And I just picked a number here, $300,000 gross income. That means before tax. If we say we're going to take the average of that 70 to 80% we discussed earlier, we're going to call it 75% of 300,000 is $225,000 that we need each year in retirement, or $18,750 per month of gross income. Using a financial calculator, which you can download an app in the App Store to get one of these if you know how to use one, or you can go out and buy one, or if you've gone through all of the extensive training and study that I have, you've got like 4 of them in your work bag or in your desk. But this is fairly simple for someone in my field. It really just keeps one you don't have. So first we know that our payment, our monthly payment that we expect to receive or that we need to receive is $18,750. Our future value, assuming that we're not planning to give a bunch of money to our heirs, we're going to set it 0. We're going to assume that while we're in retirement and not taking a whole lot of investment risk, we can maybe assume a 4% rate of return by investing in the types of things that retirees do. Whether that is fixed income securities like bonds, or whether there comes a day when a CD can earn you more than 1.25%, who knows? But nevertheless, 4% is a fairly common assumption for a rate of return during your retirement years. And we'll take a 300-month time period. That's 25 years of retirement. If it starts at 65, that's going to hopefully last about as long as the vast majority of people can hope to last. And so solving for that, we figure out that we need a lump sum of just over $3.5 million. That's all assets that we plan to draw from for our retirement income. What we've not done here, we've kept it simple. We've not adjusted for any income we expect to receive from Social Security. We're not necessarily baking in other income producing assets like rental properties or things like that. We're just saying if we needed a single lump sum and to do nothing other than draw off of that and earn interest off of that, then it's going to generate the income of $18,750 using all of these assumptions. So now that we have a lump sum that we need to work towards, again, we're doing a pretty simple time value of money calculation to arrive at the amount we need to save periodically. So we already know the future value was that $3.5 million number. Now we're going to take a higher rate of return because as we save for retirement and invest for retirement, we can afford to take some more risk because we're actively earning an income from doing dentistry. We're not reliant on market performance to assure us of a reasonable standard of living. So we can invest in riskier things and shoot for a higher rate of return. In this case, we've used 7%. We have a time period of 420 months, and all I've done there is taken the assumption that we're starting this process around 30 and we're finishing around 65, so that gives us 35 years to work off of, which is 420 months. And now we know that we need $1,972 each and every month going into some sort of an investment account or some sort of savings vehicle to attain that $3.5 million lump sum in the future. So if that sounds daunting, consider that that's only 8% of our gross income. Now, the one thing that I should emphasize at this point is that all of this is based upon very static assumptions that will not in reality be static. You'll have years of returns that are negative numbers. You'll have years of returns that are far in excess of 7%, depending on how you are investing. So with all of that in mind, this is the type of plan that you would sit down with a financial advisor to develop and then revisit no less than probably every year or two. So right now we've been talking about gross income, which means that we're thinking in terms of things like 401k plans or traditional IRAs, meaning that we put dollars in, we take a tax deduction for it, and then when we withdraw it, we have to pay income tax on the amount that we've withdrawn. That is not the only flavor that exists or is available. We can make Roth contributions, which are after tax, and avoid taxation at the time of withdrawal on both the amount that we contributed as well as any gains. The problem is that we get no tax deduction on the front end. So if our concern is in our dental practice, we have a tax problem at the end of year 2. A Roth contribution isn't going to save that. So really the question becomes, when are you most concerned about taxes, and when do you think taxes are likely to be higher, in the present or the future? And really, here's the answer to that specific question. I don't have a crystal ball, so I can't tell you which one is right, but if we expect high income tax rates now, and we expect them to be lower in retirement, then we would make traditional contributions. If we expect that we have a lower tax rate right now than we will in retirement, then we want to make as much Roth contributions as we can. Now, there's probably somebody out there thinking that they earn too much money to make Roth contributions, and you would be right if we were talking exclusively about Roth IRAs, which are subject to income phase-outs. You would be incorrect if you were talking about Roth 401k contributions, which have no income limitation. And you'd be similarly incorrect if you just made a habit of making traditional IRA contributions each year and then doing a Roth conversion, which under present tax law has no limitation in terms of income. So in the interest of time, I'm going to skip over the SEP IRA. It's a very specific tool, typically for independent contractors and specialists who, although they may own their practice, probably don't do it in the traditional sense, have no employees or just spousal employees. And then we'll move on to one of our options as a plan sponsor, the Simple IRA plan. Simple IRA plan allows only traditional contributions, meaning we're taking a tax deduction on the front end, paying the tax in retirement, and it's subject to limitations. And you can see here in 2017, for someone under 50, that limitation is $12,500, which doesn't get us to our $300,000 income goal contribution amount of just under $2,000 a month. So for a $300,000 a year income earning practice owner, odds are the simple IRA is not the best bet. It may be a stepping stone or a gateway drug on the way to a 401k for the first couple of years, but it's probably not the last stop for a high performance practice with a high income owner. We've got profit sharing plans, and the interesting thing about profit sharing plans is that they are entirely funded by the practice owner for the benefit of the employees and the practice owner. That doesn't sound very appealing in and of itself, but consider that a profit sharing plan is what allows us to have a 401k. The 401k component is nothing more than a salary deferral agreement that allows employees to make contributions towards their own retirement as well. We're going to see a little bit later the power of a profit sharing plan, so I'm not going to spend too much time here. Oops. There's the 401k. We already discussed it. We see that it allows us higher contribution limits than our simple IRA plan, $18,000 in 2017 for individuals under 50. And it's going to have some matching provisions, just like the simple IRA would for a dental office. In this case, the matching is either going to be, well, I don't need to read it to you. You're either going to do 3% of an individual's compensation on a non-elective basis, or you're going to end up probably matching individual contributions of your employees up to about 4% of their compensation. The 3% non-elective, you're paying that to your employees regardless if they actually contribute, whereas the matching, you're only paying it to them in the event that they make a contribution that's sufficient to warrant your matching. There are specific circumstances why you would use each, so don't just dismiss one or the other out of hand. And then there's the defined benefit plan, which is really a way to crank up the amount of dollars that a dentist can fund towards retirement. They're most commonly used by older docs who are behind on their savings. We're going to see some projections of how these look a little bit later. I'm not going to go into a ton of detail here only because we're limited on time. All right, so we have a number of factors that are going to influence our decision of what type of plan we would sponsor. And I've laid some out here. In my experience, most of my practice owners are looking to put big sums away on a pre-tax basis to manage their tax liabilities, and we've already discussed that ad nauseum. But there's other motivations. Sometimes you really have to have a retirement plan in place to attract and retain the best talent. Maybe you've got a big DSO down the street that's offering a massive benefits package, and this is the only way not to lose most of your employees to them. But the typical motivation is really personal financial planning for the owner docs. So here's a lot to digest, but this is literally taken from a projection that was done for one of my 401k clients. And we've separated the employees from the owners and persons married to the owner. That's Doctor One and Spouse One clearly up at the top. You can more or less ignore their ages and dates of hire in this case, as well as their hours worked. What becomes meaningful is the projected compensation. Now, as limited, you're seeing that because according to the IRS, for the purposes of qualified plans, nobody's allowed to earn more than a specified amount that gets indexed up on an annual basis. In 2017, the most you get to earn from the IRS's perspective as it respects these retirement plans is $270,000. So even if you earn $500,000 or $700,000, you're still going to get knocked back down to this level for the purposes of calculating things like matching contributions and profit sharing allocations. So we look over to the next column labeled 401k, and these are deferrals. These are dollars that the doc is essentially, and the stock spouse are essentially contributing on their own behalf, either out of their own personal paycheck, or they're having the practice make additional contributions on their behalf. That's one of the benefits of owning the practice. You get to decide where the money goes. And in this case, we're seeing a non-elective safe harbor. And that non-elective safe harbor, that would be a 3% that everyone is getting. And there's a specific reason for that if you are planning on doing a profit sharing contribution. I won't get into why you do that, but suffice it to say it works out in the favor of the owner docs to do it in this case. And then we get our profit sharing allocation, which is our next column over. And then I want to focus mainly on the last column, which are the plan totals. And what you can see is that in this example, the doc and his or her spouse has managed to put away a total of $109,500 on a before tax basis. The cost to them to achieve that was $23,628 in money that they essentially had to give to their staff. Now, if we think about this logically, for an individual or a family who's earning somewhere in the 400s, the mid 400s for married filing jointly, lower for single individuals, you're going to end up paying between the federal tax of 39.6, which is the highest tax bracket rate, between that and your People's Republic of Maryland tax, which is going to amount to almost 9% when you factor in the county, you come out to about 48 cents of each dollar gets taxed once you are above that $400,000 mark, 459 or something like that for a married couple. So the tax on $109,500 would be more than $50,000. So in this case, rather than paying $50,000 plus in tax, we've decided to incentivize our employees, give them $23,000 and some change, and the rest accrues to the benefit of the practice owner and his or her spouse. So that's pretty much a given. Nobody, for the most part, is going to say, I'd rather pay $30,000 more in tax because I really don't want to make a contribution of $23,000 to my employees. It's just bad math. Let's suppose, however, that this still doesn't quite move the needle enough for our practice owner, and we need more. Well, if we follow over, we still have a 401k plan totals column, but we've added a cash balance plan on top of it. And here we can see that in addition to that 109.5 that we gave to our owner and spouse, we're now adding to that another $121,000, bringing our overall total to almost $231,000 for the owner and spouse. And the cost to us as practice owners is summarized under the employee total, which is $31,000 and some change. So I think that the math on that, if it worked for the 401k and profit sharing, it really works here. Now, obviously, you have to have the income to justify it and the ability to save at this level. But if you're really trying to pump up your retirement savings as you approach retirement, maybe you got behind, this is a wonderful way to do it. Again, each of these dollars that's going into these plans is one fewer dollar that's exposed to tax. So let's move on and talk a little bit about what happens with these dollars once they are in this tax advantaged plan. They're going to be invested, and largely the way they're invested is going to be the responsibility of the individuals. So we're going to talk a little bit about investment concepts. We'll move quickly because I know we're going to need to wrap up here shortly, and then we can have some questions and answers. So this chart is a series of various indices. The one that most folks are going to be very familiar with that you see on this chart is the S&P 500, represented in a fairly unflattering greenish brown color. You might also see, if you're a more sophisticated investor, a lot of indices that are familiar to you, things like the Russell 2000, which is for small companies, the Barclays Aggregate, which is for bonds. The takeaway from this chart is that in any given year, there could be significant winners or losers in each investment asset class, but it's almost never the same one for more than a few years. And oftentimes when there is a big winner for several years, you only have to look another year or two later to see that it's also the worst. So the message here is you need to really spread out your investments across a lot of asset classes. You also need to make sure you're taking appropriate levels of risk based upon your time horizon. The amount of risk that you can take as a 30-year-old is just so much greater than the amount that you should be taking as somebody who's only a few years from retirement or actually in retirement. That is obviously why we've used a 7% average for our savings years, whereas we've only used a 4% average rate of return for our retirement years. That 4% might, as you approach 80 years old, be down to 1 or 2%, quite honestly, because you are really conservative by that point. And that 7% for a 30-year-old might be 10 or 12% because you can be really aggressive. You don't have that much money in a plan. You can take big swings knowing that you really don't have a lot to lose. You've got plenty of time to make it up. I assume everybody's hopefully trying to read a lot of what's on these slides as I go. I'm not going to parrot it to you only because we'd never get through this. But you can see what we have here is really a fairly simple graph that explains where each asset class, from things like treasury bills, which are short duration loans to the federal government, for lack of a better description, and are considered risk-free because we sure hope that the U.S. government doesn't default, all the way out to foreign investments and real estate and options and futures contracts at the high end of the risk spectrum. So we've talked a lot about retirement plans that are qualified in nature, meaning they're employer-sponsored and they fall under ERISA, the Employee Retirement and Income Security Act of 1974, and subject to its many amendments. What you need to know if you're sponsoring any of these plans is that you're not going to get a free lunch, so to speak. There's going to be administrative costs, and there is the potential for liability if you don't check all of the boxes. As far as being a good fiduciary, somebody who's caring for your employees and their assets the same way you would care for your own. It's not enough just to say, hey, we've got this plan, go invest as you will. You actually are going to be responsible, along with your financial advisor, for selecting investments that are broad enough, a menu that is broad enough to satisfy the appetites of virtually any employee. If you do that, that's one way that you get to mitigate your potential liability as an employer. If the only option in your retirement plan is Enron stock, you've got a problem for obvious reasons. This is the type of thing that you really need to think through and discuss carefully with a financial advisor who's very conversant in all things retirement plans and employer-sponsored retirement plans specifically. And then the same goes for things like plaintiffs' attorneys, where the Department of Labor and the IRS aren't looking, the plaintiffs' attorneys are. There are cases, and plenty of them, mostly with large companies, of plaintiffs' attorneys targeting retirement plans and their fiduciaries and saying, hey, you did a bad job, therefore you owe your participants an awful lot of money out of your own pocket. And oh, by the way, thanks for the 40% contingency fee. But as you can see in bullet point number 2, there have been cases that have targeted plans with as little as $9 million in assets, which is pretty small potatoes when you consider a plan that belongs to a General Electric or an Apple or a Ford might contain billions and billions of dollars. So to conclude, before we open it up for questions, again, I don't make a habit of reading bullet points to folks, but I hope that over the course of this presentation and this webinar that you've gotten at least a taste for how powerful a well-designed retirement plan can be in your business planning and tax planning rubric. You can really do an awful lot to improve your personal and your business's financial position by installing the appropriate plan and working with individuals who know how to really tweak them to the specific needs of dental practices. And again, this should be more than just a process that you think of in a vacuum. It's got to be holistic. You might have many other assets. You might have vacation properties. You might own the condo or the real estate in which your practice operates. So when we talk about these big lump sums, that's really a very simplistic view of this process, but at least it's one that can get the conversation started. It's a conversation, though, that warrants time and a lot of consideration. And it may involve a professional. You may want to enlist a financial advisor to help you navigate this. This is my contact information. Everybody is more than welcome to reach out to me personally. Just cautionary tale, I am just arriving for a long weekend, so if you email me immediately after this presentation, you may not get an immediate response, but trust me, I do respond to emails. They'll just be maybe a couple days slower than normal under the specific circumstances of this webinar. So with that, I don't have anything else that I need to regurgitate on you. Darren, if you want to grab the mic, and if you've got any questions that have come up out there, then by all means, feel free to MC us.
Absolutely. So thank you, Andrew, for providing all that information. Definitely a lot of content, and it's amazing that you can consolidate that into the short time period, but we know that's seriously just the tip of the iceberg there. So a couple of questions that we have here. One about whole life insurance. So the question reads, are whole life insurance and annuities good retirement savings vehicles?
Sure, thanks, Darren. So that's a fairly common question. There are a lot of folks running around who like to sell whole life insurance. They're usually associated with mutual companies, whether it's a Northwestern Mutual or a Guardian or a Mass Mutual or something like that. And it's not that they're bad. They are not bad, but they aren't necessarily the best in every situation for accumulating retirement assets. I would very carefully select a retirement advisor, a financial planner, and I would do so based upon their credentials, and I'd also try and dig a little bit more deeply into the individual's sort of conflicts of interest or their background. If they are an employee or an independent contractor associated with an insurance company, you can probably bet that you're going to hear an awful lot about insurance. If they're an independent and they are a certified financial planner, for instance, they're actually bound to a fiduciary obligation. The certified financial planners are, at least, and then the independents out there are going to be compensated really the same no matter what types of products they select on your behalf. So do your homework is the short answer to that question. If somebody's really pushing life insurance very hard as a retirement savings vehicle, then just I would encourage a healthy skepticism.
Okay. You touched on the 401k profit sharing. Question is, how much does it cost to sponsor a 401k profit sharing plan?
Sure. There's the answer to that involves a lot of different components. So the investments themselves tend to have costs. If they're mutual funds, which they more than likely will be, they're going to have an expense ratio the same as any other mutual fund. But the big dollar amounts come in the form of things like a safe harbor matching contribution or a safe harbor non-elected contribution, and that's going to be a function of the number of participants and the payroll associated with them. I really focus on the safe harbor provisions because I've seen very few dental practices that can get away with sponsoring one of these plans and having it function properly without adopting the safe harbor provision, which is one that requires one of those two matching formulas I discussed. And then beyond that, you're going to have to pay a third-party administrator, and that is also to a certain extent going to be a function of the size of your practice in terms of number of participants or employees. But you can start a plan usually for between, call it $3,000 and $4,000, and then the annual administration is going to be somewhere around $1,500 to $2,000 typically. There's some third-party administrators that will do it for a little bit less. So if anybody's interested in that specifically, then grab me offline.
All right. I've got one more here in the last couple of minutes. Do you recommend the Roth conversions and Roth contributions?
So yes, maybe is my answer to that. My gut instinct is that tax rates over time are probably going to go up, and they're going to go up specifically and most acutely for affluent people who either have high incomes or a lot of assets. That being said, most people don't earn more dollars in retirement than they did when they were actively working. So assuming that we continue to have a graduated and a progressive tax code where the more you earn, the greater percentage you pay in taxes, there's still going to be that mitigating factor out there. So I think the best answer is you can be strategic about Roth conversions, and although nobody ever wants to hear this, when you've got so much on your plate as a practice startup, and you end up, because of those Section 179 deductions and the accelerated depreciation that I discussed earlier, when you end up with very little, if any, taxable income, there is no better time to do a Roth conversion if you have IRA assets out there, because you're going to pay such a relatively small amount of tax in that particular year on that particular conversion. Once you have if you have a 401k plan or a similar retirement plan established, maybe it's not the worst idea to make some Roth contributions. Maybe not all of your contributions, but some of them should be Roth. But again, that's once we get to that sort of how much in each bucket conversation, it becomes a very personal and individual conversation that you should have with a financial advisor and an accountant.
Okay. I do have one more here if we take another minute. Someone has a universal life type policy that's basically a life insurance policy that
Mm-hmm.
can cash out later. What do
Mm-hmm.
you think of those type of policies as a retirement plan? I guess maybe it goes back to that other question.
Right, so it can work, and it does work in certain circumstances. Those circumstances are fairly narrow, and don't apply to every dentist or dental practice that ever was. Um, I regard a universal life policy or a whole life policy as essentially a wealthy person's Roth IRA, assuming that individual needs the life insurance component to some extent. Um, in other words, the way those policies function is, if structured properly, you're avoiding tax on gain, you're making after-tax contributions in the form of premium payments, and When you take them out, you're either withdrawing principal that you already paid tax on, or you're loaning yourself gains. And then when you die, you're allowing the death benefit of the policy to repay the loan. It can work well, but in terms of administrative costs, it's a higher cost option because of the life insurance loads than many of the other options that are available. But if you're a dental practice owner and you've managed to burn through the 401k and profit sharing limitations, and you've adopted a cash balance plan and also burned through the maximum amount that you can do in that sort of a plan, which you saw, we're talking quarter millions of dollars on an annual basis. If you still have a need to save some amount that's greater, then absolutely the answer could be a universal life policy. If you're an associate forever, or if you're an independent contractor forever, and you've maximized the SEP IRA in the case of an independent contractor, or you have no retirement plan in the case of an employee, then yeah, we can explore things like a universal life policy. But they are almost never appropriate as option number one for retirement savings.
Gotcha. All right, great. Well, we are running out of time here. Definitely a great conversation. Some closing items. First of all, I want to thank Andrew again for donating his time, especially while on vacation. That's very much appreciated, Andrew.
Yeah, thanks.
I know there was great content and great value here. Um, this webinar will be uploaded to our website, dtctoday.com, within about a week. If anybody has any questions, certainly you can ask Andrew. If by chance you lose his information, contact me. I'll get you in touch with Andrew. And again, not only do they help on this side, but they also help on the insurance side as well. So with that, I'd like to thank everybody and just remind everybody once again, our next webinar is on July 13th at 1 o'clock. It's going to be Marketing 101 with a company called Jameson Consulting, and they are fantastic in helping dental practices with their marketing plan. So thank you again. Really appreciate all of your time, and hope everybody enjoys the rest of the day. Thanks again, Andrew.
Thank you, Darren.